What if I told you that one of the most common goals in personal finance, paying off your house, is something many of the wealthiest investors quietly avoid? You've been told a story that a paid-off house is the finish line, that it represents security, freedom, the pinnacle of the American dream. But the wealthy have a different playbook. They see a paid-off house not as an asset, but as a trap. A financial vault where your single largest source of capital sits dormant and unproductive, potentially costing you a fortune and lost opportunity. While the average person celebrates burning their mortgage, the rich are often at the bank, strategically accessing the equity in their properties. They understand something fundamental. Your house is a gold mine, but the gold is useless until you dig it out. For decades, they've used this approach to build empires, acquire massive portfolios, and legally slash their tax bills. And today, I'm giving you their entire 20-point playbook. We're going to deconstruct piece by piece why leaving equity locked in your home can be a massive strategic error, and how leveraging it is often the key to unlocking exponential wealth. So, if you're ready to look at home ownership through a different lens, let's begin. Let's start with the most powerful concept: using your house not just as a home, but as a launch pad. The wealthy don't see four walls and a roof, they see a private bank. The simplest and most powerful reason is that savvy investors need cash. Opportunities don't wait for you to sell a house. Whether it's a dip in the stock market, a new business venture, or another property deal, speed is everything. Instead of selling a property and getting hit with a huge capital gains tax bill, they use tools like a cash-out refinance or a home equity line of credit, or a HELOC. This lets them borrow against their equity, giving them access to tax-free cash. Because loan proceeds aren't considered income, the IRS doesn't take a cut. This gives them a war chest, ready to deploy at a moment's notice, while others have their capital locked behind a door that takes months to open. Would you rather own one appreciating asset or five? That's the question an investor asks. They use the equity pulled from their first property as the down payment for their second, third, and fourth. Think about it. Imagine you have $200,000 of equity in your home. You could leave it there, earning nothing. Or you could pull it out and use it for 20% down payments on 5 separate $200,000 rental properties. Suddenly, you're in control of a $1 million real estate portfolio, all launched from the trapped equity in your first home. Now your tenants are paying down 5 mortgages, and you're benefiting from the appreciation of 5 assets. This is how real estate empires are built, not by slowly paying off one house, but by using its power to multiply. Great investors don't just wait for the market to give them appreciation, they create it themselves. They pull out equity to fund strategic renovations that increase a property's value by more than they cost. For example, they might use a $50,000 HELOC to modernize a kitchen and add a bathroom, which then boosts the home's appraised value by $100,000. They've just manufactured $50,000 in new equity. They can then go back to the bank, refinance based on the new higher value, and pull that fresh equity out for the next project. It's a cycle of improving, creating value, and extracting it that leaves passive homeowners behind. This leads directly to what many consider the ultimate wealth-building machine, the BRRRR method. It stands for buy, rehab, rent, refinance, repeat. It's the entire playbook in one acronym. You buy a property that needs work. You use your extracted equity for the rehab, forcing the appreciation. You then place a tenant in the shiny new property to get the cash flowing. With an occupied, more valuable asset, you go to a bank for a cash-out refinance, pulling your initial investment back out. Then, you take that capital and repeat the process. This is how savvy investors can acquire property after property, leaving very little of their own money in each deal and creating a snowball of assets that grows exponentially. Idle equity is dead money. It generates zero cash flow. A wealthy investor looks at $100,000 in home equity and sees a massive opportunity cost. That same $100,000, if pulled out and invested in a rental property generating $500 a month in positive cash flow, creates a $6,000 annual income stream. Left inside the walls of your home, it produces nothing. The wealthy understand that every dollar must have a job. By extracting equity and putting it into income-producing assets, they dramatically increase their income. Now we move from growth to protection. The wealthy don't just focus on making more money, they focus on keeping more of what they make. And real estate is their ultimate tool for this. This is the holy grail for building generational wealth. The strategy is beautifully simple. First, you buy appreciating assets, like real estate. Second, when you need money, you don't sell, you borrow against those assets tax-free. Finally, you hold these assets until you die. Under current U.S. tax law, your heirs inherit the properties at a stepped-up basis. This means the property's cost basis resets to its market value at the time of your death. All the capital gains built up during your life can be legally wiped away. It's a powerful way to pass wealth from one generation to the next. What if you want to sell an investment property and trade up without a massive tax bill? Investors use the 1031 exchange. This powerful part of the tax code allows you to sell an investment property and defer all capital gains taxes by reinvesting the money into a similar new property. You can keep trading up your portfolio from one rental to two, from a duplex to an apartment building, all while keeping your gains working for you instead of sending a chunk to the IRS after every sale. This is where real estate can feel like financial magic. The IRS allows you to deduct a portion of your property's value each year for, quote, wear and tear. This is called depreciation. Here's the incredible part. You get to take this deduction even while your property is likely appreciating in value. This quote-unquote paper loss can offset your rental income, often reducing your tax bill to zero. Advanced investors even use quote-unquote cost segregation studies to accelerate these deductions, creating huge paper losses upfront that can shelter other income. This is a basic one, but it's crucial. When you borrow against your property, the interest you pay can be tax deductible. Now, the rules are specific. For a HELOC on your primary residence, you can generally only deduct the interest if the funds are used to buy, build, or substantially improve the home. However, if you use the loan to buy an investment property, the interest typically becomes a business expense, deductible against that property's income. It's a government-subsidized loan to go buy more assets. This is the beautiful outcome of these strategies. By choosing to borrow against their equity instead of selling to access it, the wealthy avoid triggering an immediate capital gains tax event. The growth of their portfolio remains on paper, untouched by the IRS for now. Think about it. A person who sells their paid-off home might write a huge check to the government. An investor who pulls out the exact same amount of cash with a refinance pays zero tax at that moment. They access their wealth without giving up a slice of it. All right, we're halfway through, and if your mind is already spinning with the possibilities, that's the point. This isn't taught in schools because this is the playbook the pros use, not the one they teach the masses. If you're serious about moving from the conventional wisdom that keeps people safe but stuck, to the strategies that actually build empires, this is just the start. I've put together a resource that breaks down exactly how to think about structuring these deals and building your own real estate machine. It's for those who want to do more than just watch. Click the link in the description to learn more. Now, let's get back to the fortress the wealthy build around their assets. Wealth isn't just about growth, it's about being resilient. A paid-off house with no cash reserves is like a fortress with no soldiers. Here's why the wealthy prioritize liquidity. What happens when the market turns or a tenant suddenly stops paying rent? The homeowner with a paid-off house but no cash is in a tight spot. You can't pay the bills with your home's equity. The savvy investor who has pulled out some equity and keeps it in a liquid safe account has a buffer. This cash reserve can cover mortgages, pay for unexpected repairs, or just provide breathing room. Paradoxically, having more debt but also more cash can make you safer than having no debt and no cash. A financial advisor would never tell you to put 80% of your net worth into a single stock. Yet millions of people have most of their net worth tied up in a single, highly illiquid asset, their house. The wealthy know this is a huge, unmitigated risk. By pulling equity out, they can diversify that capital into other asset classes, stocks, bonds, other businesses, spreading their risk so their entire financial well-being isn't tied to one property in one market. Great fortunes are often made in times of crisis. When markets panic and others are forced to sell, those with cash become buyers. Having a liquid war chest, funded by your equity, allows you to scoop up undervalued assets when everyone else is running for the exits. Those who left their equity locked in their homes are just spectators. Liquidity is power, and the wealthy make sure they always have it. As we touched on with Buy, Borrow, Die, managing equity is a cornerstone of smart estate planning. By borrowing against assets instead of selling them, an investor can manage the size of their taxable estate. Furthermore, leaving heirs a portfolio of properties with manageable debt and cash flow is often far easier to divide and manage than one giant paid-off asset that forces a sale and a huge tax bill on the children. They're not just planning for their lifetime, they're planning for the next generation. In an inflationary world, cash loses value. The wealthy know that the best hedge against inflation is not just owning hard assets, but using fixed-rate debt to buy more of them. They lock in a mortgage at a fixed rate, say 5%. As inflation rises, the real value of that debt gets cheaper over time. Meanwhile, the value of their property and the rent they can charge both increase. They are using inflation to their advantage, while the person with a paid-off home just watches their locked-up equity slowly lose purchasing power. Finally, let's talk about thinking like a lender. The wealthy don't just use banks, they think like them. This sounds counterintuitive, but having zero debt can sometimes make you an unknown quantity to lenders. An investor with a portfolio of properties and a history of responsibly managing debt is often seen as a sophisticated, reliable partner. By strategically using and managing debt, they build a relationship and a track record, making it easier to secure that next bigger loan when a great opportunity comes along. Building on that last point, a long-standing relationship with a bank, built through multiple loans and refinances, leads to preferential treatment. Wealthy investors aren't just one-time customers. They're valuable partners. They often get access to better rates and more flexible terms because they are a known, profitable entity for the bank. They've proven they can handle the heat. Savvy investors are constantly optimizing. A simple example is private mortgage insurance, PMI. When you first buy a home with a small down payment, you're often hit with PMI. As soon as the property's value increases, a smart investor will refinance. They not only pull cash out, but also get rid of that costly PMI payment, a pure deadweight cost. It's about making sure your capital structure is as efficient as possible. This is a more advanced concept, but it highlights the difference in mindset. A single homeowner sees a drop in their home's value as just a loss. An investor with a portfolio sees it as a potential strategic tool. While you can't tax loss harvest real estate like you do with stocks, you can manage your portfolio strategically. If an investor needs to sell one property that has a massive gain, but another property in their portfolio is underperforming, they could choose to sell both in the same year. The loss from the second property could be used to offset the gains from the first, dramatically reducing the overall tax bill. It's about having options that only come from controlling a portfolio. This is the ultimate shift in mindset. When you have a large, accessible line of credit backed by your real estate, you effectively become your own bank. Need to buy a car? Instead of getting a 9% auto loan, you could draw from your 5% HELOC. Want to help fund a child's education? The capital is on demand. You are no longer at the mercy of traditional lenders for life's major expenses. You have control. You have liquidity. You have put yourself in a position of power. So there you have it, 20 reasons. It isn't about being in debt. It's about understanding that for investors, debt isn't a liability. It's a tool, a powerful one, when used correctly. Conventional wisdom of paying off your house is rooted in a desire for safety, and there's nothing wrong with that, but it's a specific kind of safety, one that comes at the cost of opportunity. The wealthy operate from a place of strategy. They see idle equity not as safety, but as a profound waste. They see a home not just as a place to live, but as a potential launchpad for an empire. The choice is yours. You can treat your home like a piggy bank you fill for 30 years, only to find inflation has eaten away at its value, or you can start to see it as the private bank it could be, a source of fuel to build real, lasting, generational wealth. Now, I want to hear from you. What's the one piece of conventional wisdom that this video just shattered for you? Let me know in the comments below.